I almost skipped this trade because it didn't feel clean, and that hesitation almost cost me a perfect setup. My name is Bai. I document every trade I take and every backtest I run, win or loss, as I work towards consistent profitability. In this video, I'll break down this USD JPY trade I took during a recent backtesting exercise. It wasn't my favorite setup, but the logic was clean. First, we'll review the higher time frame bias, the lower time frame entry model, and the lesson that this trade taught me. Let's jump into the chart. Okay, we turned the clock back and are here on the 15-minute. We can see that we've been bullish for a while now. We have a swing high, a swing low, and then have created a higher high here and have been chopping around, but progressively moving further down through the leg and retracing along the way. As I enter New York session, I'm going to zoom in and try to find an area that makes sense for me to prioritize as a key point of interest. It's a little challenging when you see so much price action, especially when it's so choppy and nothing is jumping out at me. Possibly we have Asia low right here, but we also have the strong low of this bullish leg. This external low here is a point of liquidity, but it can get tricky to observe price action around this area. So it's worth being careful. As we see prices moving down coming out of London sessions, yellow box, let's play price forward to see how it reacts to these two key lines on the 15-minute chart. We can see that early on in our New York session, we do get a liquidation of the first key line, which coincided with Asia's session. If we zoom in on the 1 minute, you can observe price action here. For me, this could have been an entry, since this orange line denotes the last area where sellers jumped into the market and created an aggressive move down. After liquidating Asia low, buyers stepped in and were able to close price above this key level, which could have prompted an entry. If we look at the 5-minute chart, we can see that we do have a fair value gap and clustering of orders here. You could have chosen to place your order here with the stops below the low and targeting a 3R trade. However, as we play price forward, we'll see that it ultimately does end up in a stop loss since price wanted to find more liquidity in theory before moving up to align with the 15-minute market structure, which was bullish. So with a loss in hand, the question is, what do you do now? Do you stick with your logic or do you take the day off since you've already suffered a loss? I'm learning that if I am smart about how much I risk per trade, taking one loss is not discouraging me from entering another trade if all my entry criteria are met. If we play price forward, we can see that we again liquidate our second key level, which coincided with the external low all the way over here. We can see on the 15-minute a clear liquidation of that low before a candle close above and inside of our current trading zone. Similar to our exercise before, we'll drop down to the 1 minute to see what kind of price action we can observe. Here on the 1 minute, we again are going to try to identify our next line of supply that needs to be overrun. For me, and hopefully you see it too, it's this level right here. This is the last area where sellers came into the market aggressively pushing price down, leaving a fair value gap. If buyers can break above this line and close price, that tells me again that buyers have stepped in to move price higher. Let's play price forward to see what happens. A few minutes later, we get that candle close above our orange line, which remember was the last level where suppliers aggressively stepped in. Same as always and consistent with our way of entering trades, we'll drop down to the 5-minute to see if we can find an entry. I'm not seeing anything too obvious here, so we'll drop down to the 3-minute where I do see a nice fair value gap I can take advantage of. I'll place my entry at the top and stop just below the low. Same as always, I'll target a 3R trade here, which will align well with these fair value gaps I'm seeing. Let's play price forward to see what happens. This time we get tagged in and sellers jump in again, but are unable to move price lower because those buyers have finally stepped in and caused price to rocket up, eventually hitting our take profit. The key lesson here is this: trust the price action, even when it feels uncomfortable, because the market doesn't reward comfort. It rewards clarity and execution. And this is something I'm refining myself, not avoiding trades that feel different or after suffering a loss, but validating them through higher time frame structure. Because sometimes your best trades are the ones you almost talked yourself out of. I'm not a guru. I'm just someone documenting my journey towards consistent profitability using market structure, liquidity, and price action analysis. If this breakdown helped you see the charts differently, then subscribe. And if you want to see another trade breakdown just like this, then check out this video right here. Every trade teaches us something different, and this next video might show you something you've never seen on the charts before. I'll see you there.